Hello everyone, and the noise you can hear behind me is of course the waterfall, which becomes a little bit hectic when it's raining, and being the David Attenborough of economics, I of course am out in the wilds bringing you the important market news and economics that matter on the day. And of course ACY will go to any length to bring you that information on a daily basis regardless of the weather. In Australia now, Australia Post delivers mail every second day, but ACY, we deliver every day. I hope you're having a good day and thank you for joining me. So let's cut to the chase here. As I'm speaking to you, gold is going through the roof, the Australian dollar is crashing, and US equity futures and the Australian stock market in a lot of trouble. And why is that? Totally sound fundamental economic reasons. The economic data has been ugly in the United States for a very long time as stocks stretched away. In Australia, we had data out today. In China, we had data out today. Okay, let's do China first. China inflation jumped like a kangaroo, just leapt incredibly higher. So that's getting out of control in China, just as it is in every other economy around the world. And it's certainly not a Chinese phenomenon, it's a global freedom of pricing issue and process and phenomenon. Also, producer prices in China at an incredible 27-year high. So the flow through of inflationary pressures is still coming. It's still in the pipeline. So the end consumer inflation still has a lot higher to go in China. And this, of course, is on top of the slowing that's occurring in China, which, of course, is causing problems in the construction and building industry. And I've said in my written reports, and please do check them out at acy.com, as well as all of the rest of our research team. There's Duncan, Michael, Mary, Peter, a great team there with a great variety of input to what's going on in the world's markets. And it's a great resource, do have a look. But what I was saying is that in China at the moment, I think the big call I'm making at the moment, it might be the biggest call of my career, is that China is slowing permanently. It's not a temporary slowdown in China, and it's healthy. Everyone always wanted China to slow down to more normal economic growth rates, and that is exactly what is happening here. So expect China's GDP in the future to be more like in the 2 to 4% range, maybe the 3 to 5% range, but I think that's even a bit too high, more like 2 to 4. And therefore, construction is going to be a lot lower. Demand for raw materials and energy is going to be moderated, certainly not reduced because it's a burgeoning economy. But all of these spectacular peaks that we've seen in the last 15 to 20 years, driven by this tremendous growth of China and the whole region of Asia, and the growth of intra-regional trade in Asia as the whole region came of age. All of that process is maturing at the moment, and we cannot expect the same levels of global growth that we had before COVID going forward. But particularly in China, it's a permanent slowing, so please be aware of that. Now, Australian data out today. What did we see? We saw a consumer sentiment index from the Westpac Melbourne Institute. It was up, but it's struggling. It's very low, and it's pointing to no economic boom coming out of the latest lockdowns. It's pointing to a muddling sort of discovery of some kind of semi-normal, but not normal. Things have definitely changed, most permanently also in Australia. So just be mindful of that. Yes, we will have positive growth. It will be below trend growth, and the RBA will still have to raise rates, as will be the scenario in the US economy. The other data we saw was building permits in Australia collapsing. Well, is it a harsh word? Wasn't as big a collapse as we've seen previously, but it was still a significant collapse. And it also says game over. I mean, basically what we've had is 18 months of bringing forward everyone who wants to buy a home, everyone who wants to buy a home, everyone who wants to have an investment property has either done so, is doing so, or has already ordered it. Everyone who needs to renovate a business, build a home, build an apartment block has already done so, is doing so, or the order is in the pipeline. After all of that rush of activity brought forward by an incredible overstimulus by the federal government, we had the highest stimulus per capita in the entire world, and we had 0.1% zero rates. And for some unknown reason, the RBA thought that on top of all of that, we had to have bond buying simply because the Fed had it, so we had to be sophisticated and have it as well. What a nonsense. All of that stimulation has brought forward all of this activity. I thought it was going to suck, sort of 12 months, 18 months of forward economic activity into the last year to 2 years. I think we've now sucked about 3 to 5 years of economic activity out of the future into the last 12 months and the current next kind of 6 months. So we are looking at an economic cliff. There is no doubt about it. And that will be when inflation is high, when global trade is collapsing. We're seeing China's trade collapse, we're seeing Australia's trade collapse. Please see my previous video on Australia's trade collapsing, exports down 6%. But interestingly, nickels, ores, minerals collapsing as well. So all of this paints a not rosy picture for the global equity market, the Australian equity market, the US equity market. Earnings are great, but those earnings came from the same force that's been driving inflation, freedom of pricing and easy money. Both of those things now are coming to a terrible head. It's like two rivers are about to collide and spill over the dam. And I don't think it's a very rosy outlook for equities at all. Australia, worst of all, I don't think it's a very good outlook for the Australian dollar. I think it's in a lot of trouble. There will be a firm US dollar, and the Australian dollar just has ugly story written all over it. I wrote a piece recently, the Australian dollar is going to 65 cents in 2022. That remains my call, and there's a lot of reasons for that. Gold is going to $2,500 US in 2022, and I risk the reasons. Inflation, uncertainty will be ongoing, and of course, the chart for gold just looks fantastic, the price chart. So, two big calls, and really a lot of caution is required, hesitation about your Australian stock investment portfolio. Challenging times ahead, and luckily in this new age, we have all the tools we need to manage those risks successfully. Clifford Bennett, Chief Economist, ACY Securities, bringing you what matters regardless of the weather. I've enjoyed it. I hope you have too. Please watch my next episode, and thank you very much indeed. All the best.